Our first learning objective is to identify relevant and irrelevant costs and benefits in decisions. A relevant cost is a cost that differs between two alternatives. Costs that don't differ between alternatives, in other words, we're going to incur the cost regardless of what choice we make, are referred to as unavoidable cost, and they are never relevant to our decision making. Our focus will be on avoidable costs, and those again are costs that can be eliminated in part or in whole by choosing one alternative over another alternative. There are two broad categories of costs that are never relevant in any decision, and they include sunk costs and future costs that don't differ between alternatives. Sunk costs are costs that have already been incurred and can't be avoided regardless of what a manager decides to do. Your decision to drop or not drop a class is a sunk cost because you've already paid the tuition and you can't get your money back. The decision as to whether or not to leave a bad movie or stay in a bad movie, the price you paid for the ticket is a sunk cost and is not relevant to your decision as to whether you stay or go. The only real cost with respect to whether you stay or leave a bad movie is your opportunity cost. Do you have something better to do with your time than continue sitting through a bad movie that you've already paid for? Again, the ticket price is a sunk cost. You don't get it back whether you stay or leave. Relevant cost analysis is a two-step process. Our first step is to eliminate costs and benefits that don't differ between alternatives. And again, these irrelevant costs will consist of sunk costs, costs that have already been incurred, and future costs that don't differ between alternatives. And then the second step is to use the remaining costs and benefits that do differ between the alternatives in making the decisions. The costs that remain are referred to as differential or avoidable costs. Let's consider an example. Cynthia, a Boston student, is considering visiting her friend in New York, and she can drive or take the train. By car, it's 230 miles to her friend's apartment, and she's trying to decide which alternative is less expensive and has gathered the following information. We have annual straight-line depreciation on the car. That was basically the car's cost minus some salvage value divided by 5 years. And again, this is based on then 10,000 miles driven per year. And she's calculated a cost per mile for depreciation of 28 cents. The cost of gasoline at 10 cents a mile. The annual cost of auto insurance and licensing fees, 1,380 or 13.8 cents a mile. We've got maintenance and repair cost, and then we've got parking fees at school. And in total, we have an average cost per mile of roughly 62 cents per mile. And then she's also gathered some additional information, some reduction in the resale value of her car per mile of wear and tear. She gathered information regarding the round-trip train fare. She knows there's some benefits of relaxing on the train, but we have a difficult time assigning a dollar figure to the benefits of relaxing on a train. She has cost of putting her dog in the kennel while gone, the benefits of having a car in New York, the hassles of having to park a car in New York, and then also the cost per day of parking a car in New York. Let's go ahead now and identify which costs are relevant to Cynthia in making her decision. The cost of the car is a sunk cost, and it's not going to be relevant to our current decision. Again, a sunk cost is a cost that has been incurred in the past. The annual cost of insurance isn't relevant to the decision either, because the cost of her insurance is going to remain the same whether she drives or takes the train. However, the cost of gasoline is clearly relevant if she decides to drive. If she drives, the gasoline cost will be incurred, but if she takes the train, she won't incur the gasoline cost. So, since it varies depending on the decision, it is a relevant cost to Cynthia's decision. The cost of maintenance and repairs is relevant because in the long run, the cost for maintenance and repairs will depend upon the miles that we drive our car. The monthly school parking fee isn't relevant because we're going to have to pay our monthly parking fee at school whether we drive or take the train. So at this point, we can see some of the average cost of the 61 cents per mile are relevant, while others are not. So looking closer, we can see which are some other costs that are relevant. A decline in resale value of the cars due to miles driven, that's relevant to our decision. The round-trip train fare is clearly relevant because if we drive, we don't pay the train fare. The benefits of relaxing on the train, it's relevant even though it's difficult to assign a dollar value to the benefit of relaxing on the train. And then the kennel cost, putting our dog away, which I think $40, is irrelevant because we're going to incur the kennel cost whether we drive or whether we take the train. That's a cost that does not differ between the two alternatives. Moving on, the cost of parking is relevant because if we take the train, we don't incur the cost. The benefits of having a car in New York, that would be relevant, as are the hassles of finding a parking space in the city. But because both of them are difficult to assign a dollar amount to, we often exclude those from our cost-benefit analysis. And that's a shortcoming of our cost-benefit analysis. We either have to assign estimated values or we'll exclude items that we have a difficult time assigning a value to. So if we're going to put together a financial summary, from a financial standpoint, Cynthia is going to be better off taking the train because the round-trip ticket is $104, but the relevant cost in terms of driving total to $137.86. That includes the cost for gasoline, maintenance, the reduction in the resale value of the car because of the additional miles, and the cost of parking in New York City. But again, it may be that the non-financial or non-quantitative factors have the greatest impact on our decision. She might really value having a car in New York City, or might really hate taking the train, and those costs could override benefits from a financial perspective one way or the other. Let's go ahead and consider another example. The management of a company is considering a new labor-saving device or machine that rents for $3,000 per year. Data about the company's annual sales and cost with and without the new machine are given below. Our current situation, our net operating income is $18,000. If we get the new machine, the net operating income would increase to $30,000. And we can tell that's a $12,000 difference. So in comparing the two situations, it appears as though it does make sense to rent the new machine. From a relevant cost perspective, you can see the only costs that differ between the alternatives are the direct labor cost savings of $15,000 and the cost of renting the machine, which are $3,000. So rather than doing a side-by-side total cost and benefit comparison, we can more efficiently analyze our decision by focusing only on the relevant cost, that is the differential cost and revenues associated with renting the machine. And again, that would be the savings and $15,000 in labor compared to the $3,000 cost of renting the machine. So if we use a differential cost approach, it will allow us to more clearly focus on the factors that are important in making our decision. In fact, our differential cost is desirable for two reasons. First, only rarely will enough information be available to prepare detailed income statements for both alternatives that we might be trying to choose between. And second, mingling irrelevant cost with relevant cost can cause confusion and might distract attention away from the really important information that is critical for making our decisions. For example, our production manager might be upset with the fact that our direct materials are costing us $14 per unit. And if we go with a side-by-side comparison, our meeting might get bogged down in discussions about the costs of direct materials. On the other hand, if we focus purely on the relevant costs, the labor savings versus the cost of renting the machine, our decision can stay focused on the issue at hand and not get sidetracked by the cost of direct materials. Let's walk through an example. A number of costs we're going to consider for the management of Savan AB, a Swedish manufacturer of sailing yachts, and we're going to need to identify these costs as relevant or not relevant in two different cases. In our first case, the company has chronically has no idle capacity, and one of our old machines, the model B100, is our company's constraint, and we're considering purchasing a new model B300 machine to use in addition to the company's present model B100. The old B100 will continue to be used to capacity as before, with the new model B300 machine being used to expand production. So this will allow us to increase production and sales. And the increase in volume will be large enough to require increases in fixed selling expenses and general administrative overhead, but not fixed manufacturing overhead. So we're thinking about buying a new machine, the B300, and that's going to allow us to increase production and sales. It's going to require an increase in fixed selling expenses and administrative overhead, but no change in our fixed manufacturing overhead. So let's go ahead and look at some costs and identify them as relevant or not relevant in this situation. All right, let's consider our items. The first item is sales revenue. This will clearly be relevant because we're told that the new machine will allow us to increase production and sales. Direct materials will also be relevant because as we increase production, we'll require more direct materials. We'll also spend more money on direct labor, so direct labor cost is a relevant cost, as is manufacturing overhead. Now the depreciation on the old machine, the model B100, is not relevant to our decision because it is a sunk cost and we're going to continue to incur that depreciation whether we purchase the new machine or not. We're going to keep using that old machine. The original cost for the model B100, that's a sunk cost and it's not relevant to our decision. The disposal value for the model B100 isn't relevant for our decision either because we are going to continue to operate the B100 whether we purchased the new machine or not. Now the market value or cost of the new machine, the B300, is clearly relevant to our decision as to whether or not to purchase the machine. Our fixed manufacturing overhead was not relevant because we were told that it wasn't going to change if we increased production. We had enough excess capacity, there'd be no change in our fixed manufacturing overhead, so it's not relevant to our decision. However, we were told there would be an increase in variable selling expense and our fixed selling expense, so both of those are relevant to our decision. We were also told there would be an increase in our general and administrative overhead if we purchased the B300 machine, so it is also a relevant cost for our decision. The second situation we're asked to consider, we're told that the old model machine, the B100, is not a constraint, but we're considering replacing the old machine with a new model B300 because it will offer potential savings in direct materials. So the model B100 machine will be sold, and this change in machines will have no effect on our production level or our sales, other than some direct savings, again, in direct material costs due to less waste. So now we're considering replacing the B100 with the B300, not to increase sales, but simply to reduce our direct material cost. Let's go ahead and look at our relevant cost for this situation. In case 2, since we're going to have no change in our sales revenue is not relevant to our decision. However, direct materials costs were clearly relevant because although we weren't going to increase production levels, we were going to have a savings in direct material costs due to less waste and scrap. Direct labor, we weren't changing our production and the new machine isn't any more efficient, so our direct labor costs don't change, so they're not relevant. And there's going to be no change in our manufacturing overhead. The depreciation on the old model B100 isn't relevant to our decision at all. It's again a sunk cost and will continue. The book value, or what we paid for the old machine, isn't relevant to our decision. However, if we purchase the new B300 machine, we will be able to sell the old machine, so the disposal value or what we can get for selling the old machine is relevant to our decision, as is the cost of the new model B300 machine. We weren't going to have any changes in fixed manufacturing overhead, so it's not a relevant cost. There were going to be no changes in variable selling cost, no changes in fixed selling cost, and no changes in administrative overhead. So none of those costs are relevant to our decision. And one thing we can see here is that cost might be relevant in one decision context and not relevant in another decision context.